In our last episode, we learned how to read the signs that the party's over. We studied the patterns that form at market peaks, the head and shoulders, and the double top, which alert us to an impending bearish reversal. Today, we're flipping the script. We're diving into the darkness of a downtrend to learn how to find the first light of dawn. We're going to study the patterns that signal the end of capitulation, the exhaustion of sellers, and the birth of new bullish hope. These are the giants of change, the optimistic version, the mirror image of what we've already seen. We'll talk about the inverse head and shoulders, the double and triple bottom, and we'll take a first look at rounding patterns. If you've ever wondered how to spot a potential market bottom to position yourself for a new bull trend, this video is for you. Let's learn how to identify the end of winter.
If the head and shoulders was the king of market tops, its twin brother, the inverse head and shoulders, or IH&S, is the herald of market bottoms. It's one of the most reliable bullish reversal patterns out there, and its beauty lies in its perfect symmetry with its bearish counterpart. The story it tells is one of capitulation and absorption. The anatomy is identical, but inverted. It occurs at the end of a downtrend. First, the inverse left shoulder. The price has been falling and makes a new low. Sellers are in control. After this low, a bounce or rally occurs, forming a peak. Second, the inverse head. From the peak of that bounce, sellers come back with even more force, pushing the price to an even lower low. This is the inverse head. Psychologically, this is the moment of maximum pessimism, of panic. Often, this final low forms on a spike in volume, known as capitulation volume. This is the moment when the last holders of the asset, in desperation, throw in the towel and sell. Paradoxically, this is where smart money begins to buy aggressively, absorbing all that selling pressure. After the head, the price bounces again, usually back to the level of the previous peak. Third, the neckline. Just like before, but now it's a line of resistance. We draw it by connecting the two peaks, the one formed after the left shoulder and the one formed after the head. This is the barrier that buyers must overcome. Fourth, the inverse right shoulder. After the bounce from the head, the price falls again, but, and here's the key, this new low is higher than the low of the head. This higher low is an incredibly powerful sign. It tells us that sellers no longer have the strength to push the price to new lows. Buyers are starting to show their power. The volume on this decline is usually low, confirming the lack of selling pressure. And finally, the breakout. The pattern is completed and confirmed when the price, after forming the right shoulder, rallies and breaks through the neckline decisively. And, as always, we want to see a significant increase in volume on the breakout to validate the signal. The psychology is fascinating. The left shoulder is the trend's pessimism. The head is the final capitulation. The right shoulder is the first sign of hope, the proof that sellers are exhausted. And the break of the neckline is the confirmation that a new force, the buyers, has taken control of the market.
Let's look at this real-world example in a downtrend. Here is the left shoulder, the bounce. Then the head, the absolute low. Notice the spike in panic volume. The price recovers to this level, and here we draw our neckline, a clear resistance. And now, the right shoulder. The price drops, but look, it stops well short of the head, a sign of strength. And finally, the breakout, a strong move with volume confirming the entry of new buyers. The price target is calculated exactly the same way as the H&S, but in reverse. Measure the vertical distance from the lowest point of the head up to the neckline. Project that same distance upward from the breakout point. This gives us a minimum target for the new bull trend.
Now, let's move on to a more direct but equally powerful pattern, the double bottom. If the double top was an M for murder, the double bottom is a W for win for the bulls. Its formation tells the story of a successful defense. At the end of a downtrend, the price drops to a low, bounces, and then falls again to try to break that low, but fails, finding strong support at roughly the same level. The psychology here is one of absorption and a shift in sentiment. The first bottom is formed amidst general pessimism. The ensuing bounce creates an intermediate peak, which becomes our neckline, our resistance to beat. The second drop is the ultimate test. Sellers try with all their might to break the support level, but are met with a wall of buyers absorbing all the supply. When sellers see they can't push the price any lower, they give up. Those who were short selling close their positions by buying, adding more fuel to the bullish fire. The confirmation of the W pattern comes when the price rallies and breaks the neckline, the peak between the two bottoms. This breakout, ideally on high volume, is the signal that buyers have won the battle and a new bull trend may be starting. The triple bottom is an even stronger signal, if anything. It represents 3 failed attempts by sellers to break a support level. 3 times the floor holds. Each successful defense erodes the seller's confidence and strengthens the buyers, making the eventual bullish breakout often more explosive.
Let's look at this chart. The asset is in a clear downtrend. It forms a first low right here. It bounces up to this peak, which we mark as our resistance or neckline. It falls again, tests the same support zone, and holds. The double bottom is formed. Now we just have to wait. And here comes the breakout of the neckline, the pattern is confirmed, and the price begins a strong move to the upside. The price target, once again, follows the same logic. Measure the height from the bottoms up to the neckline. Project that distance upward from the breakout point to get your minimum target.
To wrap up, I want to briefly introduce you to the slower, more gradual cousins of these patterns, rounding bottoms and tops. While the IH&S and double bottoms represent relatively sharp trend changes, rounding patterns paint a picture of a much more progressive shift in sentiment. A rounding bottom, also called a saucer bottom, looks exactly like it sounds. The downtrend gradually loses momentum, the candles get smaller, and the volume dries up. The price moves sideways in a base for a while in a state of total apathy. Then, slowly, it begins to turn upward. The bullish candles get bigger, and volume starts to increase as the new trend establishes itself. It's a slow changing of the guard, but it's very powerful and sustainable. The rounding top is its opposite, a gradual shift from euphoria to apathy and finally to pessimism. We won't go into too much detail on them today, but it's important that you recognize these formations when you see them, as they represent a very significant long-term trend change.
We've now completed our study of the major reversal patterns. We've seen how head and shoulders and double tops announce the end of rallies, and how inverse head and shoulders and double bottoms signal the end of declines. These patterns are the foundation of classic chart analysis. They're the visual representation of the battle for control of the market. But not all patterns mean the trend is about to change. Sometimes the market just needs to take a breather before continuing on its path. And those are the patterns we'll be studying in our next episode. We'll dive into continuation patterns, flags, pennants, and rectangles. We'll learn to identify these healthy pauses that often precede the most explosive moves within a trend. If you want to learn how to tell the difference between a pause and a reversal, subscribe to Money Talks US and join us for the next episode. The story the charts tell is only getting more interesting.